Hey guys, it is Julie here with TipRanks. In today's video, we've used the stock screener on TipRanks to source a few different stocks that analysts think have some huge growth potential for this next year. I'm talking price targets starting at 47% and up. So we're going to take a close look at what these companies do and what analysts are predicting for their stock's future. Just before we get into that, this is a reminder to check out the description down below for a link to get 20% off the TipRanks premium subscription. If you want to unlock some fantastic research tools, make sure to check that out. And of course, make sure that you're subscribed to the channel as well. All right, now I'm going to show you how I came across these three stocks. I found today's stocks using the TipRanks Stock Screener tool, and I just put in a few different metrics up here. So I did want a SMART score that came in as an outperform, and I did narrow down my sector a bit, mostly because the healthcare sector, we get a lot of those biopharma companies, and they can have extremely high price targets, and I didn't want to focus on those today, so just narrow down our searches. Then we're using our best analyst price target, so I wanted some big upside here from our highest rated analysts and a strong buy. So this gave us a list here, and we're going to look at a few picks from this top group. The first stock from that group we're going to take a closer look at is R1 RCM. R1 RCM trades under the ticker RCM and is currently priced at $22.12 per share, which sits just in the middle of their 52-week range. Now, looking at their chart down here, we can see they had a bit of a drop off at the beginning of May. Now, this is when they missed some expectations on their earnings per share. And then again here near the end of May after they announced a share offering. So we've been sitting fairly flat since then. R1 RCM is in the RCM business, or revenue cycle management, which is basically how doctors and healthcare providers manage their billing. They are a leading provider of technology-driven solutions that transform the patient experience and financial performance of healthcare providers. With a flexible engagement approach, R1 seamlessly complements a healthcare organization's infrastructure, quickly driving sustainable improvements to net patient revenue and cash flows while reducing operating costs and enhancing the patient's financial experience. When a company has growing pressure to run revenue cycle more efficiently, R1 plugs into their existing IT system and helps deliver higher patient satisfaction, lower costs, higher revenue, and faster collections. They have solutions for every step of the client experience, from an intuitive scheduler to verifying and registering with a comprehensive pre-registration, contactless arrival and check-in, and patient payments, where they allow seamless payment and billing experiences across the settings of care. They have over 900 clients nationwide with over 27,000 providers served. They've seen $40 billion in contracted net patient revenue for hospitals and $9 billion in contracted net patient revenue for physician practices. Their system has seen net patient revenue increase up to 5%, with the cost to collect minimized up to 20% and bad debt expense lowered up to 25%. Now, as I mentioned, they did have a big miss on their earnings per share in their latest earnings report, but their revenues did come in ahead of expectations. Their revenues came in at $342.6 million, which was up 6.9% compared to the same period last year. Their CEO said that their first quarter results reflect continued strong execution by the R1 team, as well as dividends from our investments in digitization. They are encouraged by the demand they see for their solutions and remain focused on enhancing their capabilities to deliver incremental value to customers. So let's take a look at where the analysts are on this stock. Taking a look at the analyst expectations, the RCM stock does come in as a strong buy based off of 4 current ratings. Their average price target of $32 would be an upside potential of 47% for the next year. Taking a look at our detailed list of forecasts here, we can see the most recent came 27 days ago from the Robert W. Baird firm. Now, looking at the commentary surrounding that analyst said that RCM is taking advantage of the increased outsourcing of revenue cycle services among healthcare providers while also capitalizing on a significant margin expansion opportunity by investing in the automation of its operations. Although the shares have rallied the past few years, RCM still trades at a discount to its healthcare IT peers, creating a positive risk-reward skew according to the analyst. The second company on our list today is Mogo Finance Technology. Mogo Finance Technology trades under the ticker MOGO and is currently priced at $8.07 per share, sitting in the upper range here of their 52-week range. You can see they've been as low as 88 cents in this last year. Now, obvious to see that this stock really took off in February. Now, that is when the company announced that they were acquiring a digital payment company called Carta Worldwide. They've had some volatility since then, including some direct offerings, but it's settled down around this $8 price point. As the company's name suggests, Mogo Financial Technology is a fintech company, and they empower 1.5 million users with digital solutions to get control of their financial health. Through the Mogo app, consumers can access a digital spending account with Mogo Visa Platinum Prepaid card featuring automatic carbon offsetting, easily buy and sell Bitcoin, and get free monthly credit score monitoring, ID fraud protection, and personal loans. The Mogo platform has been purpose-built to deliver a best-in-class digital experience with best-in-class products all through one account. Their Mogo Visa actually offers you 2% unlimited Bitcoin cash back on all of their purchases as well. In 2018, they launched their Bitcoin account, and their transaction volume in that category is up 1,500% year over year. Coming soon will be Mogo Crypto, which will be a commission-free crypto trading platform. And speaking of crypto, Mogo is a big investor in CoinSquare. CoinSquare is Canada's leading cryptocurrency platform, and earlier this month, Mogo announced that it now owns 39% of CoinSquare after it bought an additional 2% of their common stock. Taking a look at their Q1 2021 financial highlights, their members were up 17% year over year. Revenue was also up 14% quarter over quarter, up to $11.4 million. And their subscription and services revenue of $6 million was up 32% quarter over quarter. Let's take a look at how the analysts weigh in on the Mogo stock. The stock comes in as a strong buy based on 5 current ratings. With an average price target of $12.79, that would be a 58% upside over the next 12 months. Taking a look at our detailed list of analyst forecasts, we have several 5-star analysts, which is always great to see. The most recent price target came 14 days ago from BTIG with a 59% upside potential. That analyst values the company at $8 per share and its stake in cryptocurrency exchange CoinSquare at $5 per share. Mogo offers an attractive means through which investors can play both the digital disruption of the Canadian financial services industry and the increasing adoption of Bitcoin and other currencies. For our third company today, we're moving over to the electric vehicle industry with Lightning eMotors. Lightning eMotors trades under the ticker ZEV and is currently priced at $8.47 per share, which is less than half of the high end of its 52-week range. Now, this company did go public via a SPAC or reverse merger, and that was announced back in November. And as you can see, these prices took off. Everyone was really excited about SPACs back then. It was the SPAC frenzy, and the stock hit highs of around $17. Since then, it has just calmed right down, hitting lows of $6 back in May, now up around that $8 price point, and you can see just not much volume happening for the stock lately. Lightning eMotors is a leading electric vehicle designer and manufacturer, providing complete electrification solutions for commercial fleets based on legacy OEM chassis. They produce electric fleet medium and heavy-duty vehicles, including delivery trucks, shuttle buses, passenger vans, chassis cab models, and city transit buses. They commercialize ZEVs, offer analytics, as well as charging and financing solutions as well. Lightning eMotors enjoys over 50% market share in electric vehicles across classes 3 to 7 based on trucks shipped in the US in 2020 and the first quarter of 2021. They shipped more than 3 times the vehicles of their next largest competitor in 2020. Some of their current fleet customers include Amazon, DHL, and Keurig Dr. Pepper. As I mentioned before, they work on legacy OEM chassis. So instead of manufacturing their own, they purchase chassis from companies like Ford and GM. They have bodies made to customer specs by over 10 specialized partners and custom upfit equipment, which results in a light CapEx model. Their vehicles are already in production with projected scaling of capacity up to 3,000 units. The scaling of that manufacturing will be in thanks to these $217 million net proceeds that they received from that SPAC merger and when they went public. They're projecting sufficient cash to fund operations through 2022. Now, taking a look at what analysts have to say on Lightning eMotors. The Lightning eMotors stock does have 3 current analyst ratings, all coming in with a buy. The average price target comes in at $14.67, which would be an upside potential of 73% for this next year. And if you look at our range of price targets, they're all very closely gathered. Our lowest comes in at 14 and the highest at 15, so they're all on the same track there. The most recent rating comes from a 5-star analyst at Oppenheimer for that 76% upside. Looking at his commentary, they view Lightning eMotors as a clear leader in the electrification of Class 3 to 7 vehicles with a blue-chip customer base. With a diverse supply chain, demonstrated capability in delivering numerous vehicle types, and optionality on either growing through powertrain development, full vehicle sales, or being a leading integrator of fuel cell-based power systems, Lightning shares offer investors meaningful upside potential. So there we have 3 stocks, all rated as a strong buy, with some pretty huge upside potential predicted by analysts. Let me know your thoughts on these 3 companies. If they're ones that were on your radar already or ones that you're already invested in, make sure to leave your thoughts in the comments down below. Please keep in mind that these videos are never a suggestion to buy or sell any specific stock and are just meant for information and entertainment purposes. Your own due diligence and research is always required when making any investment decision. All right, guys, thank you so much for watching. I hope you have a fantastic day, and I will see you back here next time.